Money Radio for a really great future. We're talking real money.
Lately, I've been visiting Reddit once in a while. I just, for some reason, decided to get into it. I haven't been on Facebook for ages, so I decided to go on Reddit. And one of my favorite pastimes on Reddit is to occasionally stop by Wall Street Bets. And because it makes me feel really smart when I go there. Because these people are so stupid. They make, like, these are people in their 20s or 30s making six-figure bets on call options. And then they complain when their call option goes against them and they lose most of their money in a matter of minutes sometimes. Minutes. It's like, oh, look what happened to all my money. I'm going, do you guys realize you're betting? You're betting. It's even in the name of the forum, Wall Street Bets. We, when it comes to investing, tend to be really, really dumb most of the time. Hi, everybody. Don McDonald here on the Talking Real Money podcast, along with Tom Cock over there. There he is. See, I see him right there. That's Tom.
It doesn't work when you wave on a podcast. I just learned that. Thank you. I got to actually say something. Appreciate
really,
that.
It's audio.
Yeah, thank you. Well, we tried the video. No one watched, so I think that's because of the two of us. But
as a matter of fact, let me just. I want to see
how many are we up to now at YouTube?
Because they're still up there.
I know.
Talking Real Money is still up at YouTube.
It's just not among the top billion programs viewed or whatever.
Well, it's
not
sad.
Close. It is,
considering how many
sad
listeners we have.
I know.
I mean,
a lot
we have
of people. Yeah.
Tens of thousands of listeners.
I know, but you're not watching us.
When it comes to watching us,
I think the top-rated one still would be Retire Meat. From years before.
Look at all the Retire Meats are up there.
Yeah,
look at that.
Right.
They just went up.
Well, 2025 just went up. Yeah.
Yeah. 2025 just went up on YouTube.
Yeah. Which you can get at retiremeat.com. You can get it at YouTube.
Or you can get it at
Apollo Wealth. Yeah. All those places. So.
Wow. Look
so you can watch it free now. Yeah. But that's the most viewed.
Of our previous ones, Keep Calm and Retire Strong that we did was 713 views.
713,000?
No, 713 views.
Total.
Total.
How many of those are me? I mean, I watched 20 times or something.
Here are some with 160 views, 159
okay, we get the
views,
point. Thanks a lot.
147 views.
Yeah.
Those were a lot of work.
I know. So you
They're
get the
much
message.
more work than this one.
That was one of our former partners who told us that would be such a good idea for people to watch us. And boy, was he wrong. Sorry.
Yeah. Nobody liked watching us.
Uh-oh.
So anyway, we're done with that.
Yeah.
We are, though, going to try and help you by explaining what you're doing wrong, help you stop doing it wrong. And this came up because there's a guy by the name of Charlie Ellis.
That's a name you should know, not the rest of those yahoos you mentioned at Wall Street Bets.
Yeah, because he wrote a book about investing called Rethinking Investing.
Several books. But this
several
is one
books.
Of them.
But this is one. Mm-hmm. And he talks about the things we do wrong when it comes to investing. And, for example, I just mentioned one, the gambler's fallacy. You get something right one time, you go, oh, I think this stock's going to go up. You buy it and it goes up. What does that do? That convinces you know something you can't possibly know. You forget that winning, when it comes to gambling, is more luck than skill. A lot more. In fact, almost all of it.
Which always brings me to the one that relates to that, I think, and that's overconfidence. Most people, we're overconfident about our abilities, whether it comes to driving, relationships, other things in our lives where we think we're really good and we're not.
No, I think unlike the president, like the president, we're probably entering the post-sex era. So,
okay. But the point is, I run into this every day. Oh, I did it right for the last 30 years. It's the challenge many people face when it comes to investing is the latter part of your life turns out to be more complex than just sort of saving the money. But in a general sense, still people think, I made a lot of money, so I must have done this right. Things have gone up, so I must have done this right. So back to the gambler's fallacy. Yeah, maybe you hit a lucky strike. Maybe you did buy Palantir before it went up by whatever gazillion, or Nvidia, whatever. Your point is, and Charlie's point is, that was not skill. That truly was a gamble, and it was luck. It was luck. It has to be luck.
It can't be anything but luck, and yet we like to confuse it. Well, how is Palantir doing? I haven't.
It went up. It went down.
It
Right,
went
literally.
up, it went down. Yes, it did.
When we mentioned it on the podcast, and remember, I said it might be a little overvalued with a PE ratio of 650. It immediately turned and went down by like 30% over the next
look
few
how
days.
Powerful we are.
We just said, that's it, overpriced, boom, market went straight down. So we know what we're talking about. Pay attention.
Oh, yeah, we definitely, we know so much about the future, and we show it all the time. Another thing that we get caught up in is very, very similar to that, and that is that you believe certain things about the market, so you go out when you're doing your research, and you look for things that reinforce your already powerful belief. So it's called confirmation bias, and we see that in the news, but we also see that in investing. People who go to Wall Street Bets, all they're getting, they're in an echo chamber, so they're getting this confirmation bias that gambling is actually investing.
Yeah, and it's played out really well since 2008, right? Where people have said, well, I don't need to invest internationally because U.S. stocks make more. I don't need to diversify because I know tech is way better than everything else.
Yep.
And large companies are the future. I don't need the small. And what history has shown us, if you do that just in time for, guess what happens? The next bear market, where those things that went straight up go straight down. We've seen that. 2020, 2022, 2008, 2000, we can go back through all of that. So yeah, confirmation bias is a big one, Don. And people, again, they have a set of beliefs. They come into the market, they invest that way, and it proves to be costly over the longer haul.
The other thing we tend to be is sheep or cattle or horses or something very similar, in that we follow the group. You ever notice that with a bunch of sheep or horses?
Oh, yeah.
One horse goes, all of them go that way. It's like, oh, I better follow the herd.
Yeah.
I don't know where they're. Oh, that's a cliff. Okay, I'll go. That's good.
How often did we see that in 2020 with the meme stock at all, where people said, well, everybody's doing it, I got to get in on that one.
Let's think about let's go back to 2008, when finally, by the end of 2008, pretty much everybody had panicked out of the market.
Yeah.
By the end of 2008.
And just in time,
kind of close to the bottom.
Yeah, exactly.
And then it bounces back, and it's like, well, all of my friends are still out.
Yeah.
You know, you followed your friends out, then you wait. And here's what happened again with the upswing after 2009. We heard from people, well, yeah, I think I'm just going to wait on this, and then I'll know when it's time. My friends will be getting in. And yeah, they did. They got in after it had already gone way back up. And that's how you end up getting left behind.
Yeah. And we all feel more comfortable when we're doing things that other people are doing as well, right? And the Joneses are doing this. That must be okay, right? Wrong. The right thing is to take the advice from academics who have looked at 100 years of data and said, here's how things work, rather than the person in the cubicle next to you, your in-laws, your friends, as you said, the people that are telling you, whispering to you that they know the future, get on board and you're going to be okay. And it hasn't turned out that well.
Now, here's another one. There's one of these meme stocks, and let me just
Which
find
one?
It here. Well, there's so many. Advanced Auto Parts has been a meme stock lately. It got a lot of attention, and when we're recording this, see, we record these in advance. When we're recording this, those people who bought Advanced Auto Parts options are kind of kicking themselves, because Advanced Auto Parts was in 2021, that stock had soared as high as $234 a share.
2021, 234. Yep.
Yep. And even just a few days ago, it was over $130 a share. Last year it was $130 a share.
Yep.
In the end of 2023, it dropped into the $50 a share range, but people still bought in. They drove the price back up to 85 in 2024. Now the stock, today alone, it's down 14% on the day we're recording this to less than $40 a share.
But what you're saying is people often, and this is a very male
bought
tendency.
It along the way.
They just say, look, I'm in for the long. If it was a great stock at 200, imagine how good it is at 15. I mean,
Right.
this has a great future, but it's hard to get people to shake free of that and say that thing that people basically never do today. And that is, I was wrong. No one admits a mistake in today's world. It's sad, but it's true.
Well, it's like Palantir, which we mentioned earlier.
Yep.
Palantir, in the middle of February, was $125 a share, and by the end of February, it was $90 a share.
Yeah, right. Well, let's not talk about crypto at all. But the point is, this is a very human condition. I'm in it. I'm going to make it work. Things are going to pan out. When oftentimes you need to say, that was a mistake. I shouldn't have bought an individual stock. I shouldn't have followed a sector, whatever it is. I should be globally diversified and give up on the things that I've failed at in the past. It's hard to shake. I get it.
It's hard to shake, but if you think about things critically, and this is one of the most important things you can do as a human with a big brain, is try to think critically. Is it really possible for the majority of people who call themselves investors but are really gamblers, is it possible for the majority to win in the short term? It's not.
No. Figure that one out.
It's not. The majority have to lose. What makes you think you're smarter than everybody else? Because the facts say you aren't. So I love this line from Charlie Ellis.
Yeah, this is his new book. Mm-hmm.
Instead of trying to get more, to make more money, in other words, try to pay less. That's it. It's a simple little thing. That's what we suggest. You diversify, you own the market, because we know in the past that has worked, that the majority of people who invested in a diversified portfolio of equities, U.S., international, small, large, all of that stuff, made money. We know they did. Now, we don't know they will, but we know they did. So if you want to keep more of that money, then pay less. And that's why we like mutual funds and ETFs now.
You could buy that basket for almost nothing. I think the other one that I would add to Charlie's list is the one that people don't think of, because you mentioned the options, et cetera. People generally do not know the risk of investing, what they could lose by making some of these, and you're correctly calling them bets, wagers, gambling. They don't know the other side of the equation, or they just think, well, it's always worked out. As you said, I made one good bet, I'll make more. So not knowing that risk, overreacting to events, chasing performance, all of these things we talk about. But Charlie does a good job of outlining these self-defeating mistakes, the things that we do and that people do over and over and over again.
Can't seem to control. That's what my issue is. We don't seem to want to think critically about what we're doing wrong and fix what's wrong with us that is making us bad at this. And by the way, I just want to give you a really quick primer on risk. We talk about the word a lot, but I think we need to define it a lot more than we do. The risk you see when you play call options or put options, or you buy individual stocks trying to make a big killing in the short term, the risk you have there, well, you have two kinds of risk there. You have the risk that most of us think of when we think of risk, and that is the chance of losing a lot, if not all, of your investment. That's one kind of risk.
That's real risk.
That's the real risk. That's the scary risk. Then
Exactly.
There's the other kind of risk that is actually has proven to be highly manageable, and that's volatility. That's just the bouncing around that stock markets or bond markets or whatever they are do over time. They rise and they fall, but the trend for stocks has been always higher.
Yeah, and that's a very good point, by the way, and that's one of the three questions that people fail when it comes to financial literacy, not knowing that it is indeed safer to be in a diversified portfolio in a mutual fund or exchange traded fund than an individual stock?
Well, if you have ultimate diversification, I believe that you have now eliminated the practical risk of substantial or total loss over the long haul. I think you've come as close to eliminating it as humanly possible. Therefore, the only risk you practically have left is volatility, which is controllable.
Yeah, you can turn up the volume, you can turn down the volume, and
there's a knob.
Depending on your life, by the way, not depending on the market.
Nope.
But depending on your circumstance, when you need the money, how much you're willing to see it go up and down. And by the way, we have not promoted in months the free risk quiz we have.
We haven't. I forget about it.
TalkingRealMoney.com.
It's such a great tool.
It is a great tool. So go there.
Go to TalkingRealMoney.com, scroll down, and take the risk quiz. It takes all of 10 minutes?
Yeah, and if you don't like the result, you can come in the office. I have the version with the electrodes. You really find out about yourself there. It's good.
And if you're regular listeners to the show, you know that joke's been done to death.
Well, I'll turn it up higher next time.
Turn it up higher. Question time here on the Talking Real Money podcast.
Lots of questions do we get? I know.
Many
I'm only going to do
questions.
2, but we have a lot.
Well, that's all we can do
lot,
on this podcast, too.
Yeah, this one comes from Matt in Seattle. Thanks, Matt, for writing. Says, I'm looking to retire at 57 from full-time teaching, full 30 years. That's a long time. My wife plans to keep working. We have $740,000 in a TRS account and about the same in Fidelity. I'm putting the TRS money into the TAP annuity after separating from service. So this is a state-operated annuity, right, that gives you a little bit of an increase. It has a small COLA, I think, attached to it. My question is, if I'm going to do that...
Small colon?
Small colon. That joke's been done to death. No, it hasn't been. That joke's never been done that I remember. My question is...
or is it a semicolon?
Semicolon. Well, I'll just put it this way. I'm not going to do the test to find out. My question is, if I'm going to do that in 8 months, how should that $740,000 be allocated now? At the start of the year, I was going to put it in a target date fund, 25% in stock, 75% in bonds. I'm now thinking about moving $140,000 of that money into a money market fund within TRS, considering the high, this is where it gets important, the high stock market valuation and the trade war stoking inflation fears, which has me concerned about a significant market correction before I can secure the TAP annuity. In other words, based on today's market, Don and Tom, based on the fact that I'm going to move this money relatively soon, what should I do with it today to be ready for that to happen?
I find us fascinating. I truly find us fascinating. I have this discussion with my wife sometimes, a lot. She goes, well, we all know that the market's going to crash because of all of this trade war stuff. And I said, well, wait, hold on a minute. If we all know it, don't the people who are investing in the stock market right now, don't they already know that? Why are they
people
still
that are
trading
every day, moving securities around?
Why are they still there? Why are the banks and brokerage firms still there? Why are the institutional investors still there? If we all know that this is going to be bad, why are people there? Because we don't know. This is the thing. How can you, as an individual teacher, think you know more about what the stock market is going to do than the millions and millions of people who are investing in it right now? Why do you know more than they know? They've already built in all the things that they fear might happen into the price. You've built it in based on your own things. People, I guarantee you, people have been selling stocks with that same fear that you have. Guarantee it. And somebody else is picking those stocks up.
Cheaper.
They're buying them when you're selling them. So what makes you think you know? You can't know. Stop that.
But I will go back to what you say on a regular basis, and you're exactly right. This is for Matt. Matt, if you have a plan that says, here's the rate of return I need for the next, by the way, it could be 40 years. You're retiring at 57. Exactly. That's a long time.
Look at Harrison Ford.
He's still working hard.
He's still working at 80 something. Yeah,
I know. He's crazy. Love his work. But the thing is that you take that $1.5 million that you have between the TRS account and the money at Fidelity, you run a projection in terms of the rate of return that you need to supply the income, then you work your way back. You say, well, today I should be 50% in stocks, 50% in bonds. That would be the allocation. It has nothing to do with the fact that you're buying a TAP annuity in 7 or 8 months. Nothing. It has to do with your need for return and, frankly, your ability to take risk, which you can learn about by taking the risk quiz.
And here's the thing. Let's talk about that 50-50 portfolio. Throughout the last century, if you had invested in a 50-50 portfolio, and this is a round off the top of my head number, but I know it's relatively accurate, the worst year you would have suffered would have been a loss of about 25%.
That was probably 2008.
Yeah, exactly. That would have been the worst.
But how long did it take you to get your money back?
Not long.
Not long. I mean, the market came probably by 2010 or something. I mean, not that long. You were back. Yeah. So it feels bad. Sure.
It feels bad at the time.
It does.
But it is one of the things that we all know that there will be something that sets off a market crash of some kind. It very well, it right now, that if that crash is due to tariffs, it's already priced into the market. That possibility is already priced into stocks.
Yeah.
You can't play this game.
No.
You're going to lose.
You'll lose. Yeah. Good answer.
Got another one?
Yeah, I do. This comes from Susan in Gold Bar, Washington. I'd like to find an hourly fiduciary to help me with an inherited brokerage that includes both individual stocks and exchange-traded funds. This would be only for planning. I'm comfortable managing my own accounts once I'm sure they're properly diversified. Can you provide recommendations?
No.
I looked up a few. I can.
Oh, really?
Yeah, sure. NAPFA, napfa.org.
Oh, NAPFA. That's right.
That's
they do
a
have
series
a list
of planners where you can hire. And I looked up feeonlynetwork.com as well, where they are 100% fiduciary advisors, and you can rent
pay
them
by
out.
The hour. You can rent them out.
But I will give you a slight warning about that, just slight, because we just discussed overconfidence. Here's the thing. If you're needing help building the right portfolio, my take is you may need help into the future. Maybe. Not necessarily, but maybe. And so
because where the difficulty arises is not in the building of the portfolio. To me, that's once you understand the concepts, it's a little work, but it's not particularly complicated. You got to keep your emotional balance and you got to keep your behavior centered. But the problem really is how to extract that money in retirement in a way that's best for you, your heirs, your future plans, your tax situation, and longevity.
Yeah, and the guardrails for what you just mentioned, the bad times, because Vanguard study, for example, showed that the majority of the value an advisor adds is not just building the road, but making sure you stay on the road through and by the way, it works the other direction. When markets go up, people have a tendency to take more risk than they should. Markets go down, people have a tendency to take money out. We've seen both.
Yeah. Having someone who's always working for you acts as behavioral bumpers. It's like cheating at bowling. You know, you put the bumpers up, you never get a gutter ball.
which I should do that in life.
Well, that's what this is. That's what
that's good.
An advisor is.
This part,
they're your behavioral bowling bumpers.
I need one to follow me around.
Ooh, that is very alliterative now.
That is.
Your behavioral bowling bumpers.
I love that. Yeah. So, Susan, and by the way, so it's feeonlynetwork.com and NAPFA, NAPFA.org. You can find hourly help from those organizations, and I would trust
NAPFA what mothballs are made of?
It is. You swallow two and you feel better. So go ahead.
I'm serious. Isn't there? No, it's not.
I don't know.
They're made of something that stinks.
Yeah. Can I mention a couple more things before we run?
You do whatever you want.
Yeah. No, we mentioned this briefly, that Retire Meet, which was a few weeks ago, like a month ago. Now the virtual sessions are all up and online at retiremeet.com. And if you don't want to see Tom and just want to watch Don, you can go right to Don.
Or you can skip Don, go right to Tom.
You can go right to, who's the guy from Stacking Benjamins? Joe. You could just see Joe. Very popular. So retiremeet.com for that. In addition, here we go into the spring cleaning. Yeah, I want to fix your portfolio up a little bit, have a look at things. I'm happy to have some conversations this spring. So go to talkingrealmoney.com, click on Meet an Advisor, send me a note, and I'll have a chat with you either in person or online. Easiest easy.
Yeah, the active ingredient in mothballs is naphtha.
You were right, as
It's
usual.
naphtha. Yeah.
As I said, swallow that, you'll feel better. So take advantage of all those things.
It's a pesticide. I think it's deadly.
I don't
know. I'm guessing, but it's deadly to something.
It definitely
And generally, if it's deadly to one organism,
another
in a high enough dosage, it's deadly to all of them.
Yeah, exactly.
Anyway, thank you all for being here. We appreciate your participation, and please tell friends and neighbors and acquaintances, and even tell your enemies. Go ahead. About the Talking Real Money podcast, and join us almost every day on your favorite podcast service, and send us your questions at talkingrealmoney.com, talkingrealmoney.com, because that's the place where, we put all the stuff that's about talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.